What's up, everybody, and welcome to Tuesday's rendition here of The Cream. If you're new to the channel, welcome. The Cream is for cash flow, real estate, and money. We are full-time real estate investors. We own, operate, and manage a portfolio valued over $50 million, and we have a robust flipping business for flipping real estate that generates six figures every single month. We are passionate about real estate. We're full-time real estate investors. Been doing this longer than I care to admit. But if you're interested in real estate, we're here to help you on your real estate journey. Please like this video if you find it valuable. And don't forget to subscribe. We go live every single Wednesday. We'll be going live tomorrow, 11 a.m. Eastern. We answer your questions. Make sure you tune in on Wednesdays, 11 a.m. Eastern. But today, we are talking about interest rates. So first and foremost, I cannot stress enough how important interest rates are. They're the most important thing to everything. I mean, when rates are low, people are more easily able to access money to use to acquire things like houses and then also stocks. I mean, interest rates are crazy. When rates are low, look at what happens to the stock market. Right now, as we speak, July 2nd, 2024, stocks are pretty close to all-time highs. And that's because of this man right here, Mr. Jerome Powell, the Federal Reserve. This is what we need to be paying attention to, everybody, because they basically have indicated that in 2003, we were going to see 3 rate cuts in 2024. So in 2023, they indicated, hey, we're going to be lower in interest rates. We're going to cut rates 3 times in 2024. So the markets priced that in. The stock market prices that in. People get excited. They say, hey, Jerome Powell just said we're going to cut rates 3 times in 2024. And that floats the stock market up. And that's why we're pretty much at all-time highs. Pretty damn close. Stock market's pretty crazy to watch right now. This isn't a stock market video, but literally the entire stock market is resting on the backs of like 3 companies: Microsoft, Nvidia, Apple. You got Amazon in there as well. You got Tesla. They're not as big as the other juggernauts, but it's a really frothy environment in the stock market, and a lot of that has to do with this man right here. This is what he has said. We're going to be cutting rates in 2024, but now we're halfway through the year. We just finished the month of June, and now they're saying we may only see 1 rate cut, and that might not be till the fall. So let's take a look at some industry quote unquote experts. I'm reluctant to say anybody's an expert. What makes them an expert more than you, right? You're here educating yourself, and we're going to take a look at what some people in the media are talking about as far as interest rates go. So first, let's listen to Mr. Ted Rossman from Bankrate. He's a financial analyst, and he says, from mid-April to mid-June, the average 30-year fixed-rate mortgage rate declined from 7.33 to 7.03, according to our Bankrate data. That figure should soon fall below 7% for the first time since February. Okay, we got Ted Rossman here in the camp that rates are going to continue to go down. And I'm here to let you know, the reason rates have declined in June is because of what I'm going to talk about at the end of this video is the most important thing to monitor here, guys. Shouldn't be monitoring interest rates, monitor inflation. So interest rates and inflation go hand in hand. We've gotten some good reporting for the month of June that inflation has been kind of stagnant, even going down a little bit, and that makes interest rates go down. That's pretty much how this works, right? Let's listen to Mr. Jacob Channel. Look at this young stud out here from LendingTree. Jacob Channel says mortgage rates probably won't change all that much from June to July. And again, today's July 2nd, so this is fresh data, fresh off the press here. Says Jacob Channel. He's a senior economist at LendingTree. This means that borrowers can expect the average rate on a 30-year fixed-rate mortgage to remain somewhere near 7%, while the average rate on a 15-year mortgage is closer to 6.2%. I'm not a huge fan of 15-year mortgages, just so you know. You want to stretch that out. Inflation is in your favor. The longer you stretch out your payback time, inflation actually is in your favor, right? Because if we're not here to get too over the top, but if the value of the dollar is going down over time, then you want to be paying your loan back in the future with dollars that are worth less than they are today. We're not going to get off track here and talk all about inflation and the value of the dollar and whatnot. We can go on for hours about that's more of a campfire chat. You get me excited about that stuff, and I'll talk your ear off about the dollar and gold and interest rates and how this all ties together. I'm passionate about it. I really enjoy it as a hobby. But Mr. Channel here is saying we're going to be somewhere near 7%. Go back to Rossman. Rossman's saying he's in the camp of below 7%. We got Channel saying at 7%. Now let's look at Miss Jessica Lautz from the NAR, National Association of Realtors. So I'm sure she's an economist or financial analyst on some level. I'm not sure what her designation is, but she's with the National Association of Realtors, and she's just bulged with it. She's just coming right with it here. The 30-year fixed rate mortgage interest rate is likely to hover in the high 6s range. So she's in the camp with Rossman that we're going to be sub 7%. Channel says 7%. Lautz and Rossman are saying sub 7%. And now let's take a look at here Ms. Danielle Hale from Realtor.com. She says, in other words, mortgage rate lock isn't, I'm sorry, let me start over. In other words, mortgage rate lock in isn't going away. I'll explain what that means in a minute. But every drop in mortgage interest rates makes it easier for existing homeowners to tap into their record high home equity. That means both inventory and home sales should increase as mortgage rates drop. So this implies that she is saying mortgage rates are going to continue to go down. Everybody's talking about the most recent kind of drift down in interest rates in the month of June, right? But what she's saying here is, in other words, mortgage rate lock in isn't going away. That means the people who already have these locked in mortgages at sub 6%, sub 5%, that's not going away. These people have, these locked in low interest rates. And what she's kind of implying is, and what we've been seeing is that not a lot of homeowners want to just get up and sell their house, right? Because they don't want to trade. They don't want to pay off a 5% mortgage and then go buy a new house that's at 7%. So they're locked in. People are reluctant to sell. That's keeping inventory, low. If not a lot of people want to sell because they don't want to pay off a 5% mortgage and go sign up for a 7% mortgage, then they just don't want to sell. They don't want to, contribute to inventory. They don't want to put their house on the market. But what she's saying is with interest rates continuing to fall, that means inventory and home sales should increase. That means people now, if rates continue to go down, right? Now the people who are locked in, maybe they got a 5% mortgage, but maybe if rates were to go down to 6%, that's a better trade. It's like, all right, I can live with that. So all the people who are locked in these low interest rate mortgages, who are reluctant to put their house on the market right now because they don't want to sign up for a high interest rate mortgage, now they would be more inclined to sell, which would increase inventory. And when rates come down, that means more buyers too, right? So basically what she's saying is if rates continue to go down, you should see home sales pick up, more buyers enter the market, and then more people would be inclined to actually sell and maybe buy a new home because the rate difference is not that much. The rate that they're currently locked into at 4.5%, maybe, if rates go down to 6%, then they're like, okay, I can live with that, right? So that is what Ms. Danielle Hale from Realtor.com is talking about. This is I'm going to bring it back to the young buck, the young stud, Mr. Channel here, because he's spot on. And this is what I said in the beginning of the video. We need to be paying attention to inflation. So Mr. Channel says the last PCE, this is the personal consumption expenditures, and CPI reports. CPI is the consumer price index, right? I had to think about that one for a second. There's a lot of initials going around here. PCE, CPI, this is just reports on inflation. And he says they were both a bit better than expected, which means lower than expected in the month of June, which put some slight downward pressure on mortgage rates as June progressed. That's just like I said in the beginning, the inflation data came in a little better than expected. So the rates drifted down a little bit, a little downward pressure on the mortgage rates. Now, if July brings with it more good news, meaning more declining inflation, then we may see mortgage rates continue to show signs of falling. Yes, you're right, man. Let's see what inflation, well, we don't know. Nobody knows where inflation data is coming in. It's a big surprise every time they, unveil it. In fact, we should all be paying attention. Every time the Fed reports on inflation data, we all need to be paying attention because it affects everything, just like I said in the very beginning. And then finally here, Mr. Channel says, it's unlikely that inflation will decline so much in July that we'll see any major declines. We'll need to keep a close eye on inflation, but if it seems like it's finally starting to return to target levels, then we'll likely see Fed rate cuts and notable mortgage rate declines by the year's end. Remember, in the beginning, in 2023, they said they were going to cut 3 times. Now they're only saying they're going to cut 1 time, maybe in the fall. We'll see if they do, right? This is far from guaranteed, and if inflation picks up or otherwise remains the same, then today's high rates might stick around for longer. That's exactly what we're talking about here. So if inflation continues to trend lower, then rates should come down, Fed rate cuts and whatnot. But if high inflation continues to stick around, it's going to be impossible for the Fed to cut rates. Everything is based on inflation data. This is how it works, everybody. So with that being said, pay attention to interest rates. It's extremely important. But here's the thing. This is how we're playing this hand that we're dealt, right? We're talking macro. This is all macro data, CPI and PCE and this macro stuff. You as a real estate investor, you as a real estate entrepreneur, you need to just focus on buying good deals. You're not paying retail for anything. The interest rates affect more the retail market. These are the people you're selling your homes to. If you're doing fix and flip kind of thing. This also affects, your cash out refinances on a BRRRR deal, right? Which we do a lot of. But the bottom line is this: you make your money when you buy. Even if rates go up to 8%, 9%, if you're able to legit buy houses at 40 and 50 cents on the dollar, you're going to find a way to make money, regardless of what's going on in the macro environment. Focus on your micro environment, which is controlling what you pay for properties. This is the name of the game. This is my advice. This is what we're all about. Lead generation, lead conversion, buying cheap houses, off-market deals. This is what we talk about all day long. Buying these properties with private money. We're paying 10 to 12% on the private money that we borrow to acquire and fix houses. We're not complaining though. Why? Because we're getting such a good discount on the property. So focus on what you can control. You cannot control the Fed. You cannot control PCE data, CPI data, all the stuff that's going on. You could control what you pay for a property, and that's going to come through with your seller negotiation skills. If you're interested, we got a free book for you. Use the link below, and there's a link tree there if you want to hop on a call and talk about coaching. If you want to get a free copy of the book, it's all there for you in the link tree down below. Make sure you subscribe. We'd love to see you again. Make sure you like the video if you found it valuable. We'll be here tomorrow, everybody, 11 o'clock Eastern, and we look forward. We will see you all on the next video.